Good afternoon, Tiger investors. My name is Bruce, the head of fixed income investment at CSOP Asset Management. Today, I would like to thank Tiger's invitation and also thanks everyone to attend this webinar and to support this topic. And today, I'd like to share the updates on our CSOP US dollar money market fund. And in the first few slides, I will discuss why the current market environment benefits the US dollar money market fund investment, and both in the short term and in the long term. And in the second half, I'll highlight why money market fund makes sense to investors for now, and particularly for the CSOP US dollar money market fund before we enter the Q&A stage. And last week's FOMC, the Federal Open Market Committee meeting, saw rates being held unchanged, which is in line with the market expectations. And 2024 projections indicate just a single cut, with the Fed Chair Powell's stance being less dovish than the most recent meetings. And the median 2024 projection also showed one cut for this year and down from 3 in March. And as shown in the Fed's dot plot in the chart below on the left-hand side, most FOMC members, they continue to predict less than 2 cuts by the end of this year. And the implication to the US dollar money market fund investors is in the next 6 to 7 months, the fund's net yield is highly likely to stay above 5%. As the Fed fund rate, it's a good indicator to money market fund yield in the history. And the most recent US economic release shows a slight different picture, because the May inflation is lower than expected, as the monthly increase in terms of the core CPI was just 0.16% versus the expected 0.3%, which is the lowest since August 2021, reducing the year-over-year growth from 3.6% to 3.4%. And the headline PPI also dropped 0.2% in May versus the consensus negative 0.1%. And the core PPI was just flat. And as for the job market, the initial jobless claims unexpectedly increased by 13K to 242K for the week ending June 8, which is also the highest since August 2023. But however, some brokers still warn this could be due to the noise post the Memorial Day holiday. And the weaker than forecasted May inflation, the data did support the view that the PCE, or the Personal Consumption Expenditure Price Index, is probably going to lower to 2.6% in May. But it is crucial to be mindful that the healthcare costs have more catch-up inflation to go, and healthcare is the largest weight in the PCE index. And given the healthcare cost inflation is slow and very sticky, the core PCE might go back up in the second half of this year, and inflation might not be the main reason for the Fed cuts, if any, but rather, if the Fed is to cut in the future, it would be probably due to the cooling labor market. So as a result, if looking at the chart on the left-hand side, both the PCE inflation and the Fed fund target rate were revised up versus the FOMC's summary of the economic projections last round. But the unemployment rate forecast was little changed for this year. And the implementation here is, while the Fed has kept its so-called peak rate for this cycle for almost 1 year, it doesn't mean that there's any immediate cut is coming soon. And the unchanged Fed fund rate with a less dovish tone has another implication. As the US 10-year yield, they stays relatively high on the back of the high for longer environment. Its spread versus its G7 peers still remains attractive, and particularly as the Europe and Canada already started to their rate cut cycle recently. And these will continue to support a resilient US dollar performance as proxied by the DXY index, the US dollar index, as shown in the red chart. And additionally, the global political uncertainty, such as election results in Europe and India, also increases the near-term volatility and also the risk perception. And this provides another helping hand to hold a US dollar asset. And investors here may ask, well, it makes sense to have a US dollar money market fund in the near term. Is this still valid in the middle or in the long terms? The answer is obviously yes. Well, the market start to expect no more hikes after the most aggressive hikes by the Fed over the past 40 years. Any immediate cuts are also less likely. And even considering 4 or 5 cuts from here in the next 12 months, the Fed fund rates are likely to be maintained at a relatively high level as compared to the levels over the past 10 years, such as over 4% level. And we should also bear in mind that just back to 3 years ago, we were still under a almost zero interest rate environment. So the current 4 to 5% yield for a longer period is still quite juicy for investors. And the US dollar also has this long-term investment case. First, as shown on the left-hand side, the dollar index stays above the 100 watershed, indicating the resilience of the greenback. And more importantly, even major developed economies and emerging markets have been trying to diversify their US dollar usage over the past 40 years, maybe starting from Japan and then followed by the Eurozone and even for China in recent years. The US dollar is still in the world dominant position in terms of its composition of the world's official foreign exchange reserves, as shown on the right-hand side, which is nearly 60% for now. And another question investor may raise is, if the interest rates are quite attractive, as you said, why don't they just directly place the US dollar deposits with banks? And as compared to the bank deposits, we think the US dollar money market fund have 3 competitive advantages, namely the yield, safety, and also the liquidity. And first, as shown in the chart below, the CSOP US dollar money market fund, here as shown in the blue line, could have a more competitive return versus the US deposit rate as shown in the green line here. And this competitiveness may even be capped when the interest rate start to be lower. This is because the money market fund could lock in some investment for a longer period when yields are still high. For example, if we believe interest rates are gradually lower, but for now we think the interest rates are still high, we can lock some investment with a relatively high yield and using our pricing power and negotiating power to create an even higher yield for the money market fund and also the investors. And second, the money market fund could provide the safety because it has a highly diversified underlying investment versus direct deposits with one bank or a limited number of banks. Because the intuition is that if we place some money with the banks, we are quite safe, but we need to bear in mind there is an upper limit. And even a single bank, they may have a potential default risk, even they are very low. But comparatively, the money market fund has a diversified exposures versus a lot of banks and other high quality issuers. So these further diversified investors risk. And the money market fund also provides the capital preservation. For example, the CSOP US dollar money market fund, of course, we never said we are a capital guaranteed product, but since our inception 2 years ago, there was no single day NAV loss, which means investors' NAV, the performance after fees on a daily basis, it's up or at least flat every single day over the past 2 years, and there was no exception since our inception till now. And thirdly, the money market fund also provides the flexibility versus the fixed deposits, which typically lock the investors for 1 to 12 months or more. For example, the CSOP US dollar money market funds, it provides a T0 settlement on platform like Tiger. So investors could start to harvest yield the same day when they place money or get the money back the same day when they redeem the shares. And in addition to searching for yield need, this money market fund also works even when the interest rate gets lower in the future, as it has a competitive yield versus the fixed deposit, but provides the liquidity flexibility like a current account. For example, if some Tiger investors trade the US stocks frequently, this money market fund can be an efficient tool for US dollar spare cash. And also, the fund's T+0 arrangement will leave more room for US stocks trading, which is settled T+1 since May 28th this year. Imagine after this T+1 settlement for US stock are effective, if you still use a T+1 US dollar money market fund, then your settlement cycle will be very, very tight and maybe subject to the potential failure risk. But if you use a T+0 settlement arrangement, at least you still have 1 day to settle your US stocks trading, both buy or sell. And more specific to the Singapore investors with Tiger, we can see the Singapore 10-year yield had a high positive correlation with the US 10-year yield, and both, as shown on the left-hand side, and both peaked October last year, and the US yield was still more than 1% higher than the Singapore yield. So all else equal, this means the US dollar yield can continue to be higher than SGD yield for a period, and US dollar could be resilient versus the Sing dollar. And this also explains why our Singapore domiciled US dollar money market funds AUM is already tenfold versus its inception AUM 2 years ago. And now its AUM is over US dollar 500 million, being the second largest Singapore domiciled US money market fund already. So what makes the CSOP US dollar money market fund so attractive? And first, the underlying investments have a very high credit quality. And according to the Singapore Central Bank, the MASCS code, the minimum required underlying investment rating is A2, which is very high, a lot of notches higher than the investment grade. It also has a relatively low cost, with the management fee just being 30 bips. And even after deducting the total expense ratio, including the management fee, as shown on the top right, the fund's current net yield is still around 5.2%. And again, as compared to these direct deposit, it has a diversified exposures with no single counterparty is larger than 10%. And more importantly, it's a T+0 arrangement available on platforms such as Tiger, which can facilitate the investors to invest in this money market fund or seek for liquidity in other way around. And lastly, as mentioned earlier, on the back of high for longer environment, currently it is still a good time to invest in this fund. And since inception of the fund, it already creates a nearly 9% if you look at this current NAV in the mid-June, and over the past 2 years. And currently, its gross yield is close to 5.6% annualized, and net yield is nearly 5.2%. And the minimum subscription and redemption amount is just 100 shares or slightly above $100, and the minimum holding amount is just 1,000 shares or slightly above $1,000. And in addition to the TER, which mainly consists of the management fee, currently the fund doesn't charge any subscription fee, redemption fee, or switching fee. Thus, what you see is what you get. So in Chinese, it's just like 所见即所得. And the chart on the top right shows our underlying liquidity distribution. The daily liquidity is nearly 20% in our portfolio. And if we including the 10% weekly liquidity, the total daily and weekly liquidity is close to 30% for now. And that's why we are confident to handle a T0 flow, both inflow and outflow, even at a larger size daily. And in terms of the sector breakdown, we not only have the overnight cash and the high quality deposits, but also invest in the high quality bonds like the US Treasury, the certificates of deposit, as well as the commercial papers. And after talking a lot about the benefits of the money market fund investing, so are there any risks that investors should be aware of? I think investors should pay attention to NAV risk, the credit risk, and also the liquidity risk. And first, some investors may ask if the NAV always rises on daily basis. Unfortunately, the answer is no. There are two main scenarios that the NAV can be flat or negative daily. And first, if we are in a low rate interest rate environment, of course, this is very unlikely for now and also unlikely in the foreseeable future. But if we were in such a scenario, the gross yield needs to be, when the gross yield were even lower than the annualized fees, for example, when we were at a zero interest rate environment, then at that time, there may be a chance to see this negative NAV performance. We haven't experienced this period in our portfolio or in our fund, but we did see this period in our peers, both in Singapore and both globally. And second is that if all investors redeem the shares the same day, which also sounds unlikely, but if this happens, then the redemption may lead to some mark-to-market impact, which can be gain or loss, but it will be out of control. But this is also unlikely as the fund has a highly diversified investor base, both retail and institutions. So it's very unlikely that everyone has the same intention to sell the shares on the same day. And also, we also have a diversified investment exposures. So for large redemption, for example, for institutions, we will also get notice in advance, such as from 1 day to 1 week advance notices for us to prepare the funding. And second is credit risk. So for example, the downgrade risk or even default risk. But any default risk is also far away, as I mentioned, because the minimum rating in our portfolio is A2, maybe 5, 6, or 7 notches above the investment grade. And they are also diversified in a lot of issuers instead of a few issuers. And the third one is about the liquidity risk. But as the fund's investments are diversified in different tenors from overnight to 1 year or even above, it gives the fund a lot of flexibility. And also the nearly 30% daily weekly liquidity as shown here, together with the tradable bonds, CD and ECP, they also help us handle the daily flows. Perhaps I can pause here to see if there are any questions, because I think today's session is more of an interaction session, and we are happy to be here to answer your questions regarding these money market fund and also the market. And let me check my own Tiger map. Can money market funds maintain about 5% this year? I think just as I said, if there was only one cut this year, let's say from the upper band from 5.5% to 5.25%, and given the historical correlation or indication between the Fed fund rates and also the money market fund yield, then we are quite sure that the money market fund can still maintain an about 5% yield, at least for the rest of this year. And I think that's answer your first question. I think this question is from Lucy. And the other question is from Jack. Will the Fed cut rates this year? I think the most recent FOMC meeting gave us a very brief answer. This is still likely, and the consensus estimates together with the US FOMC members' forecast indicate one cut this year. If you have a lot of risky assets on your hand, maybe you don't like this move because there may be only one cut, maybe let's say in the third quarter this year. But if you still hold some money market funds on hand, then obviously you will love this move, because one cut means that the money market funds can still pretty much maintain a relatively high yield, at least for this year. And why can the 7-day yield of some US dollar money market fund occasionally reach as high as 6%? First of all, I can't comment directly on other money market funds, but based on my understanding, some of the money market funds, they may invest in some high-risk underlying assets, which are subject to a very high or very volatile mark-to-market impact, which means if there is some interest rate change, their price maybe go up and down very relatively significantly versus other safe assets. So this may translate it to a over 6% yield for certain periods, but maybe in the next week or in the following week, it will draw below the 5% or even just 4%. I think hopefully this answers the Luffy's question. And there's a question I got from this more about the price. But this one I don't know how to answer. But another question from Luffy is what is T0? I think as I mentioned in my presentation, a T0 arrangement, I say on Tiger, which means that if you invest in the money market fund before a certain time, let's say roughly 10 a.m. On platform like Tiger, then your interest will start to be counted at the same day when you place the money. For example, if today is June 18th, if you place your money early in the early morning, then your money will start to count interest the same day. But more importantly, for T0 is on the redemption side. For example, if you have an urgent liquidity need, let's say to buy US stocks or for other needs for your funding, if you place a redemption order the same day, let's say let's say today's morning, then you should get your money back the same day before the day ends. So that's a very useful T0 arrangement, particularly given that US stock is already shortened. Their settlement cycle is shortened to T+1. And is this one from Jen? Is this one with T0 money market fund? Yes, definitely it is, and that's why we are here to discuss this market and also the fund with Tiger. And a question from SAWCH, any charges when switch in or out for this money market fund? And for now, we don't charge any subscription, redemption, or switching fees at the fund level. So currently it's zero, and we don't think these are expected to change in the foreseeable future. Because I just see someone already answered this question after this after this question. And will the yield of the T0 money market fund, this from Hell, definitely be lower than that of T1 money market fund? It's not relevant. The T0 arrangement is more of a arrangement between the money market fund and the platform, as well as the trustee or the custodian bank, and the yield is another dimension. I think when we check whether a money market fund is good or bad, the T0 or T1 is definitely something we should consider. But in terms of the other factors, we think we should combine the different factors such as the safety, liquidity, and also the yield. For example, it's not like a simple argument like the yield is higher is the better, because it may also imply that they may invest in some risky assets. But if an money market fund, they can provide investors very stable NAV together with a T0 liquidity and also a relatively attractive yield. We do believe this kind of money market fund will be an ideal choice for investors. I'm not specifically refer to our fund, but at least for now, we are confident we can deliver this to our investors. Yeah, I think this is what I saw in the chat. I'm not sure if there are any. I think this is a good time for us to discuss this. I'm happy to see more questions, so don't be shy. I'm okay to answer questions both in English and both in Chinese. I think it's a good time for us to discuss the money market fund investing. Yeah. So before we see more questions in the Tiger app, what I can share is that we can rather treat the money market fund as a evergreen investment opportunity, because for now it's quite straightforward. We can easily invest in the money market fund with about 5% yield, but the underlying investment is not even if it's not risk-free, it's almost risk-free, because it's very high underlying liquidity and quality. But in the future, even if the interest rate, let's say, are lower to 4% or 3%, they can be still competitive, because at that time, the fixed deposit or other investment yield will be also lower at the same time. But if you compare to the direct fixed deposit, the money market fund can still provide a competitive return together with a current account arrangement, or let's say the T0 arrangement. So even at some time, the risky assets are still popular, the interest rate is not as high as nowadays, we still believe the money market fund would still play a role in your daily portfolio management or in your asset allocation. Let me see if any questions from the Zoom. No. And then maybe no more questions from the chat for now. Rafi, did you see any? Okay. Will the underlying money market fund invest in the US Treasury securities? This is from the SGD bond. Yes, we do. We can't disclose all our full holdings, but I can tell you that in our portfolio, we have a very meaningful US Treasury bill holdings. And these Treasury bill holdings are very liquid, with also with a 5% plus yield. And typically those US Treasury, we invest in them for less than 1 year period, which means we can easily hold them to maturity to harvest the yield, but also with a very safe underlying, because their credit rating is the A1 plus, which represents the highest credit rating in our portfolio investments. And in addition to those U.S. Treasury bonds, we also had bank deposit or the equivalent of the bank deposit, such as CP or commercial papers. And in extreme cases, all those investments, including the U.S. Treasury and also the bank deposit, we can renegotiate the terms or even sell them in the market to get the liquidity for investors. And if the US dollar interest rates are cut, will money market fund invest in other bond assets? I think whether they will cut or not, we have a investment universe, which means according to the MASCS code, from a credit rating perspective, it has to be A2 or above. So there is a bottom line for the safety, and also in terms of the tenors, we can only invest in the underlying securities with tenors up to 2 years. And most cases, we only invest in the securities with a maturity up to 6 months in most cases. So from this perspective, even the US interest rate are cut, we will still invest in the high quality short tenor US dollar securities or bank deposit or their equivalents to make sure we give investors the quality and the liquidity as well as some competitive yield as compared to the yield under that environment for those time periods. So we need to be fair for this part. Yeah. Do the CDO have a higher return for the fund than US Treasury? In fact, I don't. The fund are not allowed to invest in such investment because once again, when we issue or launch a money market fund, we only consider the long-only short tenor, high-quality securities, and currently we don't have any CDO or any derivatives. What we want to have for the investors is just a plain vanilla investment to let everybody has a safe liquid asset. So it's now the safest time to buy US dollar money market fund. I'm not sure if safest time is a good description. Typically, we think if you solely search for yield, I think the best timing, the best timing, it should be the end of last year. But if you talk about a decent time to invest in the US dollar market fund, we think now it's still a decent time because, as I mentioned, even considering a few cuts in the next 12 months, the money market fund can still maintain a 4 or 5% yield at least this year, and also majority of the period next year. So for now, it's still a good timing to invest in the US dollar market fund. And whether they are safe, I think whether the Fed will cut or not cut in the future, US dollar money market fund is typically be treated as a safe asset. So it's always safe to invest in money market fund unless the interest rate is dropped close to zero again, or unless there's some black swan event which can trigger a large redemption even for money market funds, then it will be a problem. But for now, we didn't foresee that scenario. And do we need to worry about the currency conversion risk? Yes, I think that's a very, very valid question because I do believe a lot of investors here, they may hold the Sing dollar, and we can't say that Sing dollar is always weak versus the US dollar, but there are two things we need to pay attention to. One is that I mentioned in the deck, the Sing dollar and also the US dollar, their yield or even their monetary policy, the paths are very similar with a very high correlation. They may go higher together and go lower together, and that's already proved in the past few years. And they peaked at almost same time, and US dollar yield is still higher than Sing dollar. And more from a tactical way to see this, the Sing dollar was very strong last year, even versus US dollar, which means if the Sing dollar has a lower yield versus US dollar, and also the Sing economy is not even more stronger than these US, then there's no strong reason to see a further Sing dollar strength versus US dollar. But in the other way around, the US dollar should at least be flat or even stronger versus the Sing dollar in the foreseeable future. So from this perspective, even from an FX conversion perspective, even you don't have any US stocks for funding, there may still be a reason to convert some of your Sing dollar to US dollar. Of course, it's not all. You still need some asset allocation for Sing dollar. Either CSOP SGD money market fund with T0 arrangement. While you are forecasting our next product launch, we don't have a Sing dollar money market fund for now. But if we have any, we definitely will try to do a T0 arrangement, because that's very important to every single investor, whether you are institutional investors or retail investors, because have interest this first day or have your money the first day you do the redemption is very, very important at the current market environment. Yeah. We will try. I don't know, but we will try to see when we will have the Sing dollar market fund first. Yeah. Oh. If we can see if we have some last question for now, but if no, then we can end maybe in 1 or 2 minutes. But still, thanks for attending this this session in the evening time. I think it's hopefully this is a fruitful session for everyone attending this session. Okay, we didn't see more questions, but hopefully everyone can have more inflow and more interest when investing in the money market fund, CSOP money market fund on the Tiger platform. And thanks everyone for attending, and thanks again for Tiger's invitation. Yeah, I will stop the sharing now and also leave the conference room. Thanks everyone.